As long as the rents support the new value, we will take that, and then we can refinance and they can pull cash out or, to get their money back out if that's what they want to do.
Welcome. This is the Hot Real Estate Investing Podcast, a podcast dedicated to helping others through real estate investing. Our hosts interview guests from all aspects of real estate investing who generously share valuable experiences and advice. Whether you're starting out or an experienced investor, this is the show for you.
All right. Hello, and how's it going? Welcome to the Hot Real Estate Investing Podcast, where I interview guests who want to help others investing in real estate. We keep these podcasts fun and full of value. And really looking forward to today's conversation with someone who's been doing commercial lending and banking for 23 years. So while we've talked a little bit about lending in the past, today we're really going to dive headfirst into commercial lending and business banking with Cyeana Johnson, a commercial lender for UMB Bank. Cyeana, thanks for joining me today.
Oh, thank you so much for having me. I'm excited. I'm looking forward to it.
Well, absolutely. I'm looking forward to this a lot because you're going to answer a lot of my questions personally. But can you give our audience just a little bit more about yourself and your real estate focus?
Yeah. So I work for UMB Bank. I've been in commercial lending. Well, I've been in banking for 23 years, commercial banking going on 13. I do everything regarding commercial and business banking. So anyone who's interested in purchasing properties or offices or anything, but I focus mainly on multifamily properties only because we have a niche. UMB is really good at it, and I've done it. I've been successful in getting lending for a lot of my clients as they tell other clients, and so it just seems that the majority of the lending I do is multifamily units.
Oh, that's wonderful. And are you only in Arizona? Or I know we've talked in the past, there's only a few number of states that you guys primarily lend out
Correct.
to?
Well, so we're in 7 states. And so, but we basically, UMB is a relationship bank. So we want to be able to have a branch in that location. So so we're in Arizona. We're mainly in the Midwest. So we can do Kansas, we can do Missouri, we can do Colorado, we can do Utah. Those are the main ones that we can do, and Texas as well. So if there's properties there, we can do it.
Wonderful. Well, we always start off our podcast with some motivation. So what is the motivational quote you'd like to share with the audience?
So mine is, I never lose, I either win or I learn, by Nelson Mandela. Because I feel like we're constantly needing to improve and learn. And so like even for myself, whenever I'm speaking with a potential client or a prospect, if I lose the deal or if I don't get it, I always ask for feedback, because I always want to know, like, what could I have done better, or what is it that you weren't satisfied with?
Yeah, that's wonderful. I think that's rings so true with so many real estate investors. It's like even some of the bad deals are some of the ones we learn the most from. Yeah. And I love that mentality that, like, hey, we're not going to focus on the losing aspect. We're going to focus on the learning aspect. And I think all real estate investors can get some value from this quote for sure.
Yeah.
So kind of transitioning into the main topic, how can you help our audience of real estate investors?
Well, I think what I'm excited about is kind of seeing it from the banking side, from the underwriter side, because I do deal with a lot of clients who don't really understand the banking portion of it and what we're looking for. Because I know you guys have to do your numbers and you want to make sure that this property will be sufficient and be able to support itself. But there's another layer to it when it comes into the banking side of it. So I'm really excited to talk about those numbers and what you guys would need in order to go to a commercial bank and get lending, if that's what you want, unless you want to go hard money, and that's a completely different situation.
No, I think definitely the goal is always the commercial lending. You got to put it into some sort of long-term financing. So I really want to focus there. Are there any that you'd like to share maybe right up front that it's like, hey, like everyone always has this question or misnomer about commercial lending. Is there something you'd like to share, maybe to get us going?
Yeah, there's a couple things. One is that most banks can, or at least our bank can go up to 80% loan to value. The difference is that it's very rarely are we actually able to go to 80% loan to value, because it's based off of the rents. It's based off of the cost to maintain that property, because not only do we ask you for the rents, but then we deduct the the taxes, the insurance, we hit you for vacancy, we hit you for management fee and replacement reserves. After we hit you for all of those, then we hit you for the payment. And then after that, that's what the number tells us that you're able to lend.
Okay.
Does that
And
help?
what is that number? Is that the debt service coverage ratio?
Yeah.
Okay.
So it's like a 1.25% debt to income ratio. And the best way that I can explain that is you take whatever, for every dollar you want to borrow, you need to have $1.25 in income. So you can back into that by going, okay, like, let me take the rents, let me deduct all of these fees, all the cost, let me deduct the payment, and what's left over has to be a 1.25%. So if you kind of take the payment of the new loan and you work that backwards and say, okay, I need 1.25% of this payment, that number right there has to be what the rents are going to be.
Okay.
Does that help?
And it's what the rents are currently, right? Not what I project after rehab the rents are going to be. So it's like current day, what the rents are have to be above that 1.25.
Correct. Now, prior to COVID, we used to be able to do those numbers. So we used to be able to use numbers like, after it's renovated. But we no longer can do that because of the way the market is and what's been going on. Maybe we'll go there, but that no longer exists.
It's just a little stricter, tighter lending right now. So what are those numbers that you utilize? Like if I'm underwriting a deal, I might use 10% vacancy. Are there rules of thumb that a commercial lending, or is that always a moving target too? Because maybe we're in a little bit stricter time. Are you using a little bit higher of a percentage?
So I do have a spreadsheet that has all the numbers in it that I could also send you. And I don't know what you'd like to do with that, or anybody who's interested, I can send them. But
sure, we'd love to share that as a resource.
We do use standard, like whatever's known for that area, for like Arizona and for Texas, there is a number that is out there that we use. So typically right now, currently for Arizona, the vacancy is 5%. And then for like management fee, it's either 6% or what you're actually getting, whichever is higher. So even though if you're charging 3% vacancy fee, we're going to use the 6 because that's industry standard. So we will be using industry standard numbers. We do for multifamily units, it's $250 a door that we charge for replacement reserves. So those numbers, and then the rest you should know. Like you should know what the taxes are, you should know what the insurance are, and then what the operating expenses are. Roughly, typically what we see is those total NOI, the total numbers for the net operating expenses are between 20 to 30%.
Okay.
That's what we're seeing.
I was going to ask that because I was like, what if I underwrite it at 20% and I'm showing you those are my numbers and you guys are underwriting it? That's actually pretty reasonable because I think the rule of thumb, we always try to underwrite at like 40 to 50%. So that 20 to 30 is actually pretty reasonable for expenses.
Yeah. And that's the thing is like, so when we get like a rent roll or expense, like income statement, and the net operating expenses are under 20, that's a flag for us.
Question it.
Yeah. We're like, okay, are you faking the numbers? Are you using pro forma? Like, where are you getting these numbers? And then we're going to want to see more information to back up those numbers.
To validate it.
Yeah.
Okay. No, that's super helpful. And then obviously those numbers, like you said, they vary from place to place. So it's very location specific, what vacancy numbers and those sorts of numbers that you're utilizing to underwrite the deals.
Yeah. But the ones, in those states that we cover, that's pretty standard. That's what we're going to hit you for. One thing I will say is that most banks do a stress test on investment real estate. And what that means is that they use a higher rate for the payment. That's not the actual payment, but so when you get a loan, whatever number that is, we're going to put it right now, it's at 8%. So
Okay.
our stress test is that if you have a mortgage at 8% and this is the payment and we hit you for all of those numbers, we want to see a 1.25.
Gotcha.
And if we
And you
don't,
really are qualifying at that? Or yeah, what happens if you
yeah.
don't?
So if we don't, we lower the loan amount and you have to come up with more cash.
Okay.
So that the Excel spreadsheet that I have, it tells you when you put in the rents and you hit them for all of those numbers, it will tell you what the max loan amount is available per those rents. So
Gotcha.
some of my clients will come back to me and they'll do hard money and they'll come back and they'll raise the rents. And when the rents get to that number, they come back to me and then we do the loan for them.
The long. So is that kind of, because like in Arizona specifically, right? Like deals don't pencil right now at 1.25, right?
Yeah.
So and that's kind of the struggle is like, hey, I want to get some long-term debt on this. What's my best play? Is it to take some hard money and be able to do the loan and then have to refinance? So would you say a lot of that's kind of the norm right now, that a lot of your clients are doing the hard money to lock it up and then
and then raise rents.
stabilizing it?
Yeah. Or they'll use cash. They'll use their own cash. Because we can turn around and refinance it we like to see it 2 years. We know that's not possible. So what we'll do is we'll turn around and we'll do another appraisal once they have the leases. Because the way we use the income approach. So when it's appraised, we look at what the appraiser put the income to be for those units. So we don't really look at what the overall appraised value is. I mean, we do, but what I'm saying is like,
you look at the NOI,
yes,
basically.
we look at their income, the income that it supports. So as long as the rents support the new value, we will take that and then we can refinance and they can pull cash out or, to get their money back out if that's what they want to do.
Do you guys offer a lot of those hard money loans as well? Like, are you doing the hard money and the lending? Okay.
No, unfortunately we don't. I mean, like one of my biggest clients, he does do hard money. I think he has 12 million with us and then he has 198 doors. And so, and he's always buying. So he'll buy hard money. He'll fix it up. He'll raise the rents as soon as the rents are up. To what they need to be, he comes to me and then we turn around and we refinance it for him.
Okay. And you said you want 2 years, but in those cases, like, are you okay if it's seasoned? Like, what's the minimum time those rents have to be seasoned? Like 3 months, 6 months, a whole year? 6 months.
We want 6 months of a minimum 6. We'd like to see a year, but we can, if we can show, you can show that you show me the numbers. I renovated. Here's my leases, and these leases are showing that they're a year. We want to see at least a 1 year lease.
They're not month to month and things like that.
We don't like month to month. So if we do, we can do it, but it's going to be harder to get it approved if you only have 6 months of seasoning with month to month leases.
Okay, that makes sense. But if you have those long-term leases signed, then you can probably get away with 6 months of seasoning with the current rents.
Correct.
Okay.
And sometimes we can even ask for an exception because the great thing about our bank is that we don't have just a box. We really, it's not like you have to hit all these numbers in order for us to do the loan. It's more of like if you have a client who has 10 years, 15 years of experience, they have proven records that they know what they're doing. They have a lot of liquidity. They have 6 months reserves. They have money in their savings, and it's a little riskier. We'll consider it. We'll do it because of the background, because of the liquidity, because of all those things. We can go ahead and do a loan for them.
Oh, that's wonderful to hear. And I love like the personalization of that, because I think so many banks I've spoken to, even like they have their buy box or their bucket, and they're like, no, we have too many loans at that. We're only servicing loans at this level or this specific. So that's nice that you guys kind of look at it individually.
Yeah.
So maybe let's get into maybe like an example multifamily deal just to help kind of reinforce some of the things we've talked about. So let's say that there's a deal, it's about 1.5 to 2 million. So let's just call it 2 million to make the math easy.
Okay.
And that loan to value, like you said, there's really not a hard, strict rule. Like 80 is the most, but really you're working backwards from that debt service coverage ratio 1.25. But one of my questions that I commonly get, and I sometimes get confused about, is like the liquidity and the net worth rules associated with these higher mortgages, right? Most people coming into this go, hey, I can't qualify for a $2 or $3 million loan, so I'll never be able to do it. But it's actually, you guys as the bank are really looking at the asset, like you said, and the net operating income of the asset. But what is, like, the person signing on the loan, what are the requirements for the person signing on the loan?
So we want to see 6 months, minimum of 6 months of the payments somewhere.
Okay.
Somewhere. So say they have a 401k, say they have, stocks of bonds, or, or they have a line or a mortgage or a house that's paid off, that has equity in it. And then they have assets. So as long as you can show that, like, if you default from the loan, that we will collect the money somehow, that you have a backup plan.
You have 6 months to be able to pay that somehow if everything went to crap.
I mean, cash is king. So yeah, we would love to see that you have 6 months of that payment in savings or in a checking account. We'd love, ideally, that's the best option. But if not, we'll look at all the assets you have, and see if that adds up and if there's enough. But, like, we don't want to see someone who's asking for a $2 million loan who has $30,000 or $10,000 in their accounts.
Not enough to cover 1 month.
Correct.
If everything went south, like, they couldn't cover it all.
Correct.
And then what about net worth? Like even though they have that liquidity, let's say perhaps to cover the 6 months, like, let's say they only had a net worth of $500,000, can they qualify for a $2 million loan, or what's that?
I mean, I guess we need more information. So yes, I've done loans that look just like that have, that only have a net worth of 500,000, but that's also because they had just sold a couple of investment properties and then used that money for a down payment, or, to renovate, to purchase one, renovate it, throw all the money in there, and now are asking to refinance it. So all their money's in the property that they just bought. So if we can explain it, if we can understand it, we'll consider doing it. Because I said earlier, it's not all black and white. There's always situational. There's a story to tell. As long as I can tell a story about it, we can look into doing it.
So is that why, like, relationships are so important? Like, the fact that, like, you can tell a story of, like, your client, as opposed to me going to 5 different bankers that don't know me from the next guy and don't know my experience. Is it better to try to stick with one specific lender or commercial banker so that they can kind of advocate for you in some of these potential, like, more difficult conversations?
Yeah. I mean, yes, the answer to that is yes. Like, you want to stick with someone who can understand your story and can speak to it, because at least of our bank, when I get a deal, like, say you wanted to do a loan, this $2 million deal, there's a 5-page essay that I have to write about that asks a series of questions that I have to write up and have to answer, and then I present it to a panel of underwriters, and and I'm explaining to the underwriters why we should lend you $1.6 million for this, and this is why, because of all this experience and stuff like that. If you just go to the big banks, and we are a big bank, we do we get business from the Chases, the Wells Fargos, the Bank of Americas out there, but they do have a box, and they do have where they don't want to hear a story, they just want to know, hey, how much, what's this number, do they have that? If not, then we can't do it, and we will consider it.
I love it.
Yeah.
You're speaking music to my ears, and I think a lot of investors' ears out there, because I think it's the toughest thing to do is, find lending, especially in the market today, and to find, we always talk a lot on the podcast about having your team, or having, building your team out. And I think, your lending expert is one of the most vital parts to any kind of real estate team, but especially in multifamily as well. Anything else, I guess, like in that deal, let's just say, like, it's $2 million, we're at 75% LTV. I mean, what other things should people be thinking about to make them as likely to get a loan from your bank or another bank as possible? Like, what are
Well,
some things I can do to make myself more attractive to your bank?
I mean, one is know your numbers.
Okay.
Know like, know that the banks are gonna ask for leases. They're going to ask for income statement. They're gonna ask what is your portion? Like, is it triple net piece, or are you paying for all the are you paying for all the expenses and stuff like that? But another thing is, one thing you can absolutely do on your own is take a calculator, put in like 75%. So that would, if I want a $2 million deal, that would put it at like $1.5 million, right? And then
Yep.
if you do at seven, let's just say 8%, that payment is $11,000. So
Okay.
you're going to want to see rents that are, you're now looking at like what, $24,000 a
Yeah.
month in rent that you're going to need to show in order. And
To be able to cover
and
that.
that's before. So you actually need a little bit higher, because we're still going to hit you for the 5% vacancy and all this stuff. Another thing I really want people to know is that you're going to want to get a loan when it's as close to being 100% leased as possible.
Okay.
When you don't, you're kind of shooting yourself in the foot, because we're
Okay.
going to take whatever rents you have right now,
Currently.
and
Yeah.
then we're going to hit you for 5% vacancy, and then we're going to deduct all those fees. So if it's not completely leased out, you're losing. Do you understand what I
That
mean?
percent plus another 5%, basically. So
Correct.
I always hear kind of like 90 for 90. Is that still a thing? Like 90% occupancy for 90 days, like is kind of a minimum threshold barrier for a lot of
Yeah,
lending?
I mean, we want to see that it's higher risk when it's month to month. It's higher risk if you haven't held the rents for 3 months.
Okay.
But again, yes, we want to see that, but
Okay.
there can be exceptions.
Definitely. So would you say that, or how much stricter are lending guidelines now as opposed to maybe last year? And where do you maybe foresee, or when do you foresee maybe an ease in lending if you had your crystal ball?
Well, it's a lot harder. It's
Okay.
especially since
Like you said,
yeah.
like you kind of said earlier, right? You could do loans a little bit easier before, but right now it's a little bit harder. But are you seeing less loans
Yes.
or okay.
Yeah, we're seeing less loans. We're seeing not many people, it was busy. It was crazy. It was,
Oh, it was nuts. Yeah.
but then it was at the other side of that token, everything was super expensive to purchase. So now it's kind of leveling off. But all the really smart people that have way more degrees than I have are all saying that by the end of this year, rates are going to start hopefully going down.
Yeah.
That's what they're saying. But at the same time, here's another thing is that there are still investors out there who got loans when they were 2, 3, or well, more like 3%, 4%.
Yeah.
One thing I didn't know if you knew, but when it comes to commercial real estate, loans are usually only 5 years. So
Yeah.
they're amortized, between 20 and 25. But every 5 years, you need to redo that loan. So, in the next 2 or 3 years, those
A lot of
loans are
loans are
coming up,
coming due.
and they're going
Yeah.
to need to be refinanced, because I don't think that people have, $800,000 or $1 million sitting around to pay off that loan. So people are always still going to need lending. But it's
Yeah.
if you set up the right numbers and you look at your numbers and say, okay, this is what it needs to be in order for me to get a loan, then you're setting yourself for success.
No, that makes a ton of sense. And that's kind of what I continue to hear too in the market. And a lot of people, if maybe they're waiting on the sidelines to buy, it's like, well, a lot of these loans are going to come due that we're at 3 and 4%, and they're not going to make sense, or they're going to be forced to sell because they can't get the lending where it makes feasible, or they, like you said, have to do a capital call or come money out of their pocket to be able to get a loan. And so they'll have to offload some of them for a little bit, maybe a little bit of a discount. So I'm hopeful for that,
Yeah.
honestly, but
We'll see. But here's another thing is like those loans are also, really refinance them back out to 25. So the loan is less, the
Gotcha.
rate is higher, but the loan is less, and then you can send it back out to another 25.
Gotcha.
That's an option as well, unless you're looking to pay it off sooner. But I mean, really, all banks typically do between 520, 525. Those are the two ones that I see the majority, meaning that it's fixed for 5 years, but amortized for 20 or amortized for 25 years.
Okay.
That's
That
what we're
makes sense.
seeing.
And does that depend on the loan size, or is that pretty much across the board what people are doing?
No, it's across the board that people are doing.
Okay.
I heard that there was like one bank in Arizona that did a 30-year one, but I don't think they're around anymore, to be honest. I mean, there could be, but I haven't heard since
Sure.
that everything that's going around. But you also have to understand, like, a lot of things change within 5 years. So you're wanting to see those rents should be year after year increasing, or
Sure.
you should want to, at least.
Yeah. Well, yeah. If you're managing the property at all the right way.
Yeah, correct.
So, I mean, maybe my final question, what is a common myth that you hear about commercial lending that you're like, that's just not true? Like, you just always hear people say it's harder to get lending, or maybe I always hear it's way easier to get commercial lending because it's based on the asset and not the person themselves. I mean, what's maybe one that you hear that you want to, set the record straight on?
Yeah, I mean, both of those are completely true. Like, it isn't as hard as people think it is to get a commercial loan. As long as you find the right property and you have the right leases, I feel like right now it's actually really good to get to find 1-year leases. So as long as that, and you can show that you can do 6 months worth of reserves, you're pretty good. Like, yes, we want someone who has good credit, but that's not a decider. Like, most people who are doing this have decent credit, like above, we don't want to see anybody above a 620. I don't think I've ever who's come to me asking for a loan have below 620. And really, as long as you don't have any collections, any bankruptcies, and you can show that the building can support the debt, do it. Try.
Yeah. Okay.
Love
it.
I think I don't think it's as hard as people think it is, and that's especially because I'm on the underwriting side. I'm seeing what we're looking at in order for it to make sense.
Sure. No, I really appreciate that. Those are all the questions I have for you. Is there anything maybe I missed or something you'd like to share with the audience that I didn't ask you about?
No, I'm trying to think. Just one thing I will say, I mean, I know you guys focus on multifamily. We typically look at multifamily, anything between 5 doors and above.
Okay.
And one thing I will share is that if you have a book of a lot of multifamily units, we can put them all into one loan. So that is something that we can do, and we have
like a big portfolio loan.
Yeah. So we do portfolio loans. We don't really, scream on top of the roofs and tell everyone, but that is something that we can do as long as they, again, support the larger debt. So if you have, 4 loans out there from 4 different properties, as long as they're in the same, like in Arizona or Phoenix or whatever, we can also do that.
I love it. I did not know that,
Yeah.
but that's definitely a good pearl and thing to keep in the back of my mind, especially as I'm doing some more of the smaller multifamilies, like you said, like 5 and above, but under 40 units right now. So that's definitely something I hadn't thought about as potentially, pooling a few of those properties together in the long term.
Yeah, you can absolutely do that.
All right, Cyeana, are you ready for the hot seat?
Oh, goodness. I think so.
All right. Well, we ask all our guests the same final 4 hot questions. And so, number 1, what is one book you'd recommend to someone wanting to know more about real estate investing?
For beginners, I really recommend the I'm sure you've heard it, the High Performance Habits on How Extraordinary People Become That Way. I don't know if you've heard it, but by Brendan Burchard.
Okay.
That's a pretty good book.
Have to look it into it now, and read it. I love new book recommendations.
I know you should. I mean, most people who want to do something like this should try to read at least 5 books a month. It's hard though.
Oh, it's definitely hard.
Def-
All right. What, number 2, what is your favorite productivity tip or trick? Maybe a tool or some time saver app that really makes you more productive than most?
I mean, I use Salesforce and I have it on
Okay.
my phone and it links up to my calendar on my phone. So
Okay.
that is my lifesaver. I put everything in there. And even
Okay.
it connects to my own calendar. So whenever I'm really forgetful because I'm jam packed all the time. So I
Yeah.
always put everything in my phone, like everything in
Okay.
my calendar. And it's been a lifesaver because I'll forget, but then I pull up my phone. I'm like, oh, I have this going on. I totally forgot about it. But I think just using that tool can really
So
help.
important.
Yeah.
Yeah, like schedules are crazy, especially when you have a few kids,
Yeah.
like I know you do.
Yeah.
Like, like it ends up being just crazy that you have to keep your schedule straight. And I
Mhm.
love that. Like anytime you can integrate calendars or seamlessly, I think it helps everybody out. What's your biggest real estate mistake or failure, and what did you learn from that experience?
The reserves,
The
not,
reserves.
I would say, because I also, I've owned 6 properties.
Okay.
None were multifamily, they're all single family. But one thing I feel like in the beginning, or people don't realize that they need replacement reserves. They need to have, I would say, at least 6 months of replacement
Yeah.
reserves at all times, because you never know what's going to happen. You never,
Yeah.
it's like when you least expect it, there's a leak in the roof. When you least expect
Yep.
it, something comes up. And then if you don't have those reserves, you're scramming to find money to cover because, cash is
Absolutely.
king.
Yeah, I think that's such good advice. I think so many people get into real estate investing and think, oh, as long as the numbers make sense right up front, I'm good. And then they start either drawing from that money or doing something with that money. And I always tell people, like, build that bank account up and have your reserves and have those capital expenditures paid for before you start ever drawing money off any of
Yeah.
your real estate investments.
And especially with the taxes and the insurance, because commercials don't impound. So you have to so you should, no matter what, have at least a couple $1,000s sitting in that account for taxes because they're due twice a year.
That's super good advice too, because I don't think many people realize that, like, yeah, the escrow in a primary or a residential home, and that doesn't happen in commercial lending. So you have to be mindful and have that money set aside.
Yeah.
You're dropping all kinds of pearls. I love it. Finally, if you could be remembered for one thing, what would it be?
To be,
I know it's a tough one.
I know. I would say I wrote it down and I was like, where'd it go? I swear I wrote it down. To be solution driven, like to be a problem solver. That's what I want.
Yeah.
I want people to like come to me when they, want to figure out how to get it done and don't know how.
Yeah.
Because I do have so much experience and I look at things differently. So that would be what I would like to be remembered as.
I love it. You're going to get bugged a lot more from me personally.
Yeah.
But this was a lot of fun, Cyeana. And the best for those Hot REI community members that want to interact with Cyeana, the best place to reach her is on LinkedIn at Cyeana Johnson. And she's with UMB Bank. We will provide all her contact information in the show notes. Thanks again so much for joining me today. I think that the audience learned a ton about commercial lending. I mean, I think for someone that doesn't know anything about commercial lending, listening to this show and podcast, I think will really help them get onto the right foot. And if you're looking for an amazing commercial lender, you can reach Cyeana with her contact information in our show notes. But ultimately, thank you for tuning in today and commit to taking action today to move your investing forward. Take care and God bless.
Thank you for listening to the Hot Real Estate Investing Podcast. Check out our website, hotrei.com, for additional content and resources. And please take a moment to subscribe and leave a review so we can continue to bring even more value to others through real estate investing.